We've been taught to recognize candlestick patterns, but not how smart money actually uses them. In this video, you'll discover how to read candles the way the banks do so you stop falling for traps and start trading with precision. Here's what you'll learn: the deceptive candle, the fakey pattern, the engulfing trap pattern, the silent flip, the silent drop, the green wall setup, and the red wall setup. By the end of this video, you'll know how to spot these secret smart money candles, how institutions use them to trap, mislead, and dominate, and most importantly, how to use them in your favor to make high probability trades. The first pattern Munehisa Homa used to read market emotions is what I call the deception candle. It's also known today as the pin bar, and if you're not careful, it's the candle that can either make your account or break it. Here's how it looks: a small body near one end and a long wick showing strong rejection. It tells us price tried to go somewhere but was slammed back. Retail traders often see this and get excited. They think, that's a breakout, I'm jumping in now, but smart money thinks differently. They use this candle to manipulate emotions, to lure traders in, take their stops, and then reverse the market. Now that you understand what the deception candle is, let me show you 3 ways smart money uses it to trap retail traders and validate powerful zones. Look at this chart. Price taps this level and reverses. It pulls back again, taps it, and reverses once more. Now we have a strong support level forming. The market pulls back again, and this is where retail traders start setting their traps on themselves. They place limit buy orders at the support level, expecting the market to bounce one more time and go up again. They're convinced this is a clean retest. Some enter early, others wait for confirmation, but almost all of them hide their stop losses just below the support. And what happens? The market spikes below the level, grabs their stop losses, forms a perfect pin bar, and then reverses aggressively to the upside. That's not a failed setup, that's a liquidity trap engineered by smart money. If you understand how this game works, you don't panic when your stop gets hit. You re-enter confidently because you recognize what just happened. The pin bar wasn't rejecting your idea, it was clearing out the weak players before the real move began. Now let's look at how smart money uses the pin bar to confirm powerful zones. Here's a chart. The market moves up aggressively, leaving behind a clean demand zone. What happens next? Price returns to that zone and gets instantly rejected, forming a well-shaped pin bar. This is key. The rejection tells us that limit orders were waiting. Smart money didn't chase the move, they were waiting patiently. That pin bar acts like a signal. More institutions see the reaction and jump in. What happens next? The market explodes upward. Here we have a strong supply zone. Now, how do we know it's real and not just a random pause? We apply our criteria. Look at the size of the candles in the move down. They're big and impulsive. That shows institutional interest. The zone is fresh and the previous support is broken. Now we know this isn't just noise. This is a smart money zone. Watch what happens. Price pulls back, taps the zone, and forms a clean pin bar. That's not coincidence, it's confirmation. The wick shows limit orders were triggered. Other large players jump in, and price drops aggressively. The fakie is one of the most powerful smart money candlestick patterns and one of the most dangerous traps for retail traders. It looks like a breakout, it feels like a breakout, but it's not. It's a setup designed to trap breakout traders and leave them stuck on the wrong side of the market. Let's break it down step by step. First, the market forms an inside bar. That's when a small candle forms completely inside the previous candle's high and low. This shows consolidation. The market is pausing, waiting for the next move. Then, price breaks out of the inside bar. Retail traders get excited. They jump in, thinking a new trend is about to explode. They enter, set their stop loss, aim for their target, but they're walking into a trap. Suddenly, the market snaps back, closing back inside the inside bar's range. That's fakey, a fake breakout followed by a real move in the opposite direction. And just like that, breakout traders are stuck, and smart money is in control. Now, let's look at a few variations of the fakie that smart money uses to trap even more traders. The bullish fakie. Price fakes a break below the inside bar. Retail traders panic and go short, but then the market snaps back up and explodes higher. The bearish fakie. Price fakes a break above the inside bar. Buyers jump in, thinking it's the start of a breakout, but price quickly reverses and collapses downward. The multi-bar trap. Sometimes, the fakie forms after 2 or 3 small candles following the inside bar. This creates a deeper trap, giving traders more time to believe in the breakout, which makes the reversal even more painful and more powerful.